US investors are buying Canadian natural gas assets. And while the private market has recognized significant value in the Montney Foundation here in Canada, public markets have not moved to reflect that. I think this creates an opportunity to buy into really high quality Canadian oil and gas stocks, specifically Montney focused, gas focused producers, which we'll talk about at the end of this video. But first, we should talk about what exactly these US investors are looking for. Why are they buying into Canada? Why are those assets valuable? And why is their value continuing to grow as 2025 and 26 play on? And we got to start with a Reuters article that came out this week, because this really did change not only sentiment, but change our understanding of the value of Canadian Montney Basin assets. Because it talks about the Ovintiv deal with NuVista that we all know about. We remember Ovintiv coming back up here to Canada, obviously formerly a Canadian focused company, buying out NuVista, which was a really high free cash flow yielding, really valuable natural gas mid-cap, small-cap player, and sort of, pushing a little bit of focus. It was followed up by Baytex immediately focusing on Canada. It was this big moment of, okay, US dollars coming back up here to Canada. But it's really just one of many deals. And what this article from Reuters has told us is that there were a lot more deals that never happened. All the tire kicking the experts kept telling us about, a lot of it didn't lead to the kind of money that we were expecting. And that could mean that there are a significant number of deals sort of out there floating around in the world of proposals and negotiation that have not materialized yet. And each time we see one of these deals, we have seen a re-rating of the value of the assets owned by those companies. Think about, for example, Ovintiv buying out NuVista, valued the production of that company and really the long-term value of their asset much higher than NuVista was valued on the public market. And that was hardly an expensive deal if you look at it. It wasn't like investors there got this crazy tailwind. Same thing did happen with Meg Energy getting bought out. Now, obviously a little outside the Montney, but very similar story. The value of the assets they sit on were greater than the value of the company trading on the public market. I think a lot of value is going to be unlocked over the next 2 years or so, because I think the twilight of US shale, the story of American energy independence is shifting. And all of this is great if you own Canadian Montney producers with a wealth of assets, with huge potential, with stuff that they could either be selling off or developing, depending on what is more valuable. And the current environment is so bearish that it could create gigantic opportunities to pick up these companies at crazy cheap valuations, while their base asset, their base natural gas production is actually way higher free cash flowing than the oil market that so many investors are so bearish on right now. So let's talk about exactly what the deals were they saw in this article. And the Reuters article does a really good job of explaining everything I just said. And again, this is a story we've told on the channel, right? Drilling prospects, I should say, in the Permian are worse. We've seen a lot of data coming out showing a decline in US production. 2025 looks to be the peak. Looks like production growth is going negative. It has been revised down by the EIA. There's been a lot of stories there, right? A lot of, rig counts are down, so they're not drilling as many new wells. Well counts themselves are slowly starting to decline. The Permian seems like, at least for now, in volume, it's not necessarily growing anymore. And since that's been the main driver of growth in the oil market, that's a big deal. Problem is that a lot of the producers that grew the Permian are not Exxon or Chevron. These large American super cap or mega cap or whatever you want to call them producers. These guys are really capital disciplined. They are efficient producers. They have really, really well-run businesses. The guys that really drilled the most wells were smaller, pioneer style, not to name drop, companies. These smaller American firms that needed to grow in order to see the success they wanted to see. Those firms are functionally impossible to run anymore. You can't just produce more wells in the Permian and hope that somebody will buy you eventually. That junior miner style doesn't work anymore. So a lot of that money that would be in the Permian over the last decade needs to go somewhere. Those same investors are looking for those same returns, and it really does look like the Montney might be the relatively untapped potential location for a lot of that activity. Now, we will talk about the demand side of the story after we go through this article, but just seeing that put out there by Reuters really does validate a lot of the discussion we've had on the channel about this. Now, obviously, it talks a little bit about the Montney, all things that I think we here on the channel know, but here's something we didn't know. Not only were there significant transactions being made in the Montney, NuVista, Noventive, there was also NGP, Energy Capital Management. They funded, I can't say this word, Signet, their takeover of more assets in the Montney. And there have been other deals that did not go through. So SM Energy, EOG Resources, Cord Energy, all placed unsuccessful bids, which is really interesting. And Varus says that Montney has the longest resource lifespan of all North American unconventional oil and gas plays, 45 years of drilling inventory at current pace of development. That's huge. Permian has maybe 11. So if you consider the fact that Permian has been this huge source of growth and now they're plateauing and they only have 11 years until that's just about it, that's crazy from the perspective of all the gigantic infrastructure that's been put in place for natural gas. We have seen more investment in LNG over the last 5-10 years than ever before. We have seen a structural increase in demand. We're seeing a second wave of structural increase with the whole AI data center story. Yeah, nuclear is hopefully the energy that these centers will use long term, but nuclear is going to take a decade to build out. And that's a lot of time for a lot of resource to be used. So all of this is working as like a sponge, just sucking the natural gas out of the North American market that already uses a significant amount, particularly times like this when it's really cold out. Now, we can't control the weather and it didn't go as cold as expected, which obviously meant that the $5.50 natural gas price did drop off. But look at all the opportunity there. There's a huge opportunity for producers. And the fact that the Montney has 45 years to the Permian's 11 means that there's a lot of producers looking to come here. Now, potential for growth has shifted. And this is where we get into political risk, something that has held a lot of Canadian energy firms back. In the last decade, let's say, Canadian energy optimism has been at a, not all time, but like brutal low. It's just about as bad as it could have been. There was US shale who just dominated, could produce at a cheaper price, was pushing a lot of Canadian crude down in discount. We saw the differential blow right out. Obviously, COVID sent the whole price negative. And then you also saw then the spike up in 22 to this run down to the 50s. All of this has created a really bad time for sentiment. Let's be honest. A lot of folks have been burned and they've turned their back on energy. And so value is absolutely to be found here. Because when the market dislikes something, when the market is so focused on the risks, in this case, commodity risk with oil, it does not value the stock the same way that the company might actually be worth in the long term. We've seen this again and again. We've done videos talking about both Tourmaline and CNQ, so Canadian Natural, over the last 2-3 weeks here, where analysts have decided that fair value is about double the current share price based on cash flows, based on the actual predicted growth of the company, based on a reasonable discount with a reasonable weighted average cost of capital. The analysts have been able to say, listen, fair value based on the cash flows here is almost double what the company is trading for. But of course, the companies trade so much cheaper because there's so much risk. So as we see political risk dialed down, now, people will argue, anytime you get into political, people are going to argue so many times that you're wrong, no matter what you argue. But we've seen it dialed down at least a little here. And so if that maybe was 30 to 40% of what kept investors away, the rest right now is basically just commodity risk. And if you look at the actual price of natural gas, Canadian producers should be singing from the rooftops, should be so excited right now because they've seen a sustained, heightened cost of natural gas in Canada for the last couple of weeks. And it looks like it's going to continue because not only is it a very cold winter up here in Canada, but also LNG Canada Train 2 is getting online. And this sort of consistent demand is going to be there. And then you get to the thing that provides the real long-term potential. Because not only has demand come to production here in the form of LNG, but now we're seeing it come to production in the form of data centers. One move that came out of this thawing of the political apathy or anger towards the energy sector from the government was the reduction in the clean energy regulations here in Alberta. And this created an opportunity for significant natural gas powered electricity generation that wasn't possible before. That means that all these data center projects that have been sort of ideas have suddenly been coming true. Now, this is an article from the Calgary Herald here, which was absolutely a bombshell to read. Basically, and I won't make you read through the whole thing. Check it out if you can. But basically, $6 billion in deals are on the table, going for FID right now. There's about $18 billion in deals that are beyond speculative. It's going to happen. We don't know exactly where, when, so on. We got to work out those things. And then there's up to $100 billion in potential deals that have been speculated about. So if you think about the amount of money coming into not only just the province, but coming into the natural gas demand pipeline here, you look at significant build out of demand in the Canadian basin. And that creates just such a big opportunity, because one of the biggest things that's been a challenge for producers is that if you can't market your assets, if you can't get them to market, then you get brutal pricing. We saw pricing go negative a month ago because you could not get natural gas out of the Montney Basin. You just couldn't. There was maintenance going on. There was all sorts of challenges. And so now seeing production and demand coming to the same place, seeing producers essentially ramp down production growth at the same time, and that's not just in Canada, that's just about universally, the same time as demand growth in natural gas specifically is ramping. There's a huge mismatch here between the actual dynamics of the natural gas market as a commodity and the dynamics of the stock market for natural gas producers. There's a gigantic mismatch. Again, US private money is flooding into Canada. This isn't something we've seen for a decade. It's flooding into these specific assets that are owned by these companies. And yet today I have two companies that I can cover, and I know you know what they are, that are flat on the year. Now we'll start by talking about the biggest producer, Tourmaline. If we look at a price chart for Tourmaline over the last year, they are down 2.5%. The same year that LNG Canada finally did come online, the same year that the price of Canadian natural gas has bumped all the way up to $3, the same year that we saw two new major long-term LNG expansions planned that are going to FID sometime in the next 6 to 12 months that have now got government support, the same year that we finally saw AI data centers coming to Canada, coming to the Montney, to these producers, the same year that we also saw an overhaul of the Canadian regulations on energy, boosting natural gas use in the long term, with a company that has sacrificed short-term gain for long-term production. The stock is still flat. All of that long-term thinking, all of that long-term production, all of that long-term demand growth has been worth negative 2% on your money. I thought Tourmaline was a deal back in March. I thought it was a steal deal in April after everything was crashing. And to be honest with you, I think it's still a crazy deal today. I think the company has a couple key things going for it. They're the largest producer. They sit on the most assets in the Montney. Of the Canadian natural gas producers, these guys have the biggest wealth of assets. They can continue to produce or grow production, or, as they have been, invest into their assets, invest in the infrastructure to be as efficient as possible, as profitable as possible, investing their marketing in order to sell it at the best basins, which, by the way, can change over time for all those scared about the LNG excess, surplus, whatever you want to call it, glut, to use the word that's so popular right now. People who are scared about that potentially happening thanks to all this North American LNG, well, they can just market it elsewhere. If the differential starts going away between North American natural gas, European or Asian natural gas, then They'll simply market it here in North America. This is the point of the marketing team. Anyways, all of these things that they've done, all of these plans led by a CEO who, by the way, is buying shares right now at this stock price. When it touches a $60 level here, Mike Rose buys shares. All of that basically means huge, huge vote of confidence from the board, vote of confidence from the company in the long-term value of their assets, the long-term free cash flow they can generate. It just means that you're not going to get rich quick. Like, I'm sorry. If that's what you're looking for, this is not the place to look. Instead, this is something that will continue to grow production, continue to find the best value for their asset long-term in a market that clearly is saying, not, oh, maybe, but saying right now that the value of the assets they sit on is greater than the value the company is trading at, that the actual value of that firm is greater than the value of the stock. And I'm sorry, if you'll give me that opportunity and I can buy and I can sit on those shares for the next 2, 3, 4, 5 years, who knows, then I am very happy. That's the kind of investor that I want to be. And the crazy thing is, Tourmaline isn't the best deal out there with all of those things. As much as I love Mike Rose, anytime you could hear that man talk about the natural gas market, I recommend you do it. I think if you're a real investor, if you're somebody who wants to own a company and understand a company, you want to dive into the value and what they do well, go listen to Mike Rose. He's been on so many different podcasts. Obviously, In the Money did a great one there. He did one with Trevor Rose that was awesome, right? Go check those out. Mike Rose talks so well about the market. He's such a knowledge-filled person. He's this wealth of knowledge walking around still running a company, which is just such a valuable thing. Love to hear him talk about the firm. Love the plan. I love the vision long term. It's still not the cheapest firm out there. It's still not the best value buy in the Canadian natural gas market. The reason Tourmaline isn't the cheapest or the best or the lowest priced is because ARC Resources is here. ARC Resources now has both the vote of confidence of Rick Rule and Eric Nuttall. And while it might not be the name brand player that, I think In the Money put out on their Twitter that Tourmaline was the most suggested stock in Canada in 2025. Because a lot of institutional investors, the kind of people who go on In the Money, see the value, even if the market doesn't agree. And even then, energy investors are looking at ARC and are thinking that there's a crazy opportunity here. Because while it is technically up for the year, it is down $5 a share off of its peak. And it is down because of short-term challenges that are over. And I'm just going to say it. The challenges with Hitachi that dropped this stock so low are over. The opportunity for a rebound is there. Before we saw the price of oil crashing and we saw so many investors running from the space, and we saw that gigantic $5.50 Henry Hub price get cut back down to around $4. Before that, it was running up to almost $27. So we had halved the drop throughout this year, and now we're back down to not quite the lows, but near there. Now, ARC Resources is benefiting from several trends here. It is benefiting from this natural gas trend that we're so focused on. They're a natural gas heavy producer, but also we talked about this when we did our deep dive of this company 9 months ago now. They are also a major producer of condensates. We are importing condensates here in Canada because we need them to ship oil. These guys are a major producer of an asset that is continuing to be in demand year over year that isn't just the base commodity. So not only do they have a growth story in the natural gas, they have a growth story in the condensates business. Canada has huge opportunity with natural gas. I believe it is far better than the opportunity in American natural gas players if you are willing to wait. If you're trying to make the most money off of a short-term boom in natural gas pricing, sure, you can probably find a higher free cash flow yield in the States. If you model it out and you look at where natural gas is expected to go at strip pricing over 26, there's probably better deals. Eric Nuttall has done that story plenty of times. But if you are looking for a long-term structural bull market, I think we have one here in the actual asset, in the commodity, that isn't reflected in the stock price. That creates opportunity. I genuinely think that's a huge opportunity. That's what I've been buying. Now, I think it's really important when I do videos like this, when I talk about these opportunities, I want to end today by reminding people that this only makes sense to invest in if it fits your portfolio, you're properly diversified, you're looking for energy exposure, you're looking for an opportunity to take those commodity risks, political risks that come with these companies. Also, as ARK has showed us earlier this year, operational risks. And it is a reasonable size position. It is money that you can afford to lose. You're not betting money that you're going to need in the next year, 2 years, 3 years. And you're willing to be patient, because if you lose money over the next 3 months and you sell and then the stock triples over the next 5 years, you're going to be kicking yourself. If you're the kind of investor who can put this in an account and then not look at that account for a long period of time, these stocks look like interesting opportunities. The whole market here in Canadian natural gas, specifically, we're talking Montney producers today. There are plenty of producers in other basins that I think are still super valuable, right? Like Peyto, we've talked about a couple of times. Obviously, the oil sands players have huge long-term stories there. But if you're looking at Montney assets, which is what mainly American money is starting to really pick up on, these producers have huge, huge opportunities to grow. You don't usually see this in Canada, where you have these large cap companies that maybe are even better value than the small cap ones, because honestly, usually the large cap ones are the ones that people know and the small caps are forgotten. So the fact that there's an opportunity here just honestly excites me. We've talked about it a lot of times on the channel at this point. And I'm going to continue to tell this story until it's no longer there, until there is no longer an opportunity to get these things at such a cheap value. I'm going to talk about it. So I hope you got some value out of this video. I hope you enjoyed it. If you made it this far, please do like the video. It means a lot. And let me know in the comments down below, what do you think about the Montney? Do you think we're going to see like a slew of merger and acquisition deals over the next year? Think there's going to be a bunch more money coming in? Or do you think that this story is somewhat played out? It's 2025 trend, and maybe 26 will bring us somewhere different in the energy market. Love to hear your thoughts in the comments below. As always, again, if you like this video, please do like it. If you like what we do here on the channel, you like covering these topics here in Canada, please do subscribe. And I hope I see you in the next one.